Hello and welcome. Right now, something massive is happening that most people in crypto still haven't understood. A technological collision is taking place, one that is reshaping markets, rewriting trading strategies, and quietly creating the biggest wealth shift since the early days of Bitcoin. Crypto isn't just going through another bullish cycle or another round of hype. What's happening now is far deeper and far more powerful. Stablecoin regulation is exploding around the world. The Genius Act has just been signed. Stablecoin flows are about to go nuclear, and this shift could change everything in the crypto market. If you stay with me through this video, you're going to understand exactly why this regulatory wave is happening, how stablecoin flows will influence Bitcoin, altcoins, DeFi, and trading, and how you can position yourself to take advantage of this once-in-a-generation shift. So let's begin with the big question. Why is stablecoin regulation suddenly taking over the crypto world? It starts with trust. Stablecoins serve as the bridge between crypto markets and traditional finance. Move your dollars, move your crypto, hedge, trade, borrow, lend. All of it often happens through stablecoins. But until now, many stablecoin systems operated in regulatory gray zones. With the Genius Act now live, we've reached a moment of clarity. The US government has established a federal framework for payment stablecoins, requiring 100% reserve backing, audits, issuer registration, transparency, and consumer protections. This matters because when regulation hits, capital moves differently. When stablecoin flows shift, crypto flows shift. Think about this for a moment. When stablecoins are regulated, when they're trusted as safe digital dollars, then large institutions, hedge funds, banks, and traditional finance outfits start handing crypto on-ramps like never before. The narrative goes from risky crypto to regulated digital dollars plus blockchain rails, and that cements crypto's position in the financial system. This will trigger massive flows into Bitcoin dominance, into major altcoins, and into DeFi infrastructure. And the flip side, when regulation is vague, unstable, or poorly enforced, it exposes risk. A single failure in a stablecoin system can trigger a run, a cascade, and wipe out liquidity in minutes. The Genius Act explicitly addresses this by prioritizing stablecoin holders over all other creditors in insolvency, tightening reserve requirements, and aligning state and federal frameworks. That means fewer surprises, but also new opportunities for those who act early. Now let's talk about what this means for the crypto markets, how stablecoin flows will change where money moves, how trading gets triggered, and how you should adapt your mindset. When stablecoin regulation is clear, issuer confidence goes up. More stablecoins mean more liquidity, more trading, more margin, more lending, more borrowing. That's fuel for crypto. Conversely, when regulation scares away issuers or restricts flows, liquidity dries up and risk spikes. For example, if new rules slow stablecoin issuance or restrict redemption options, then crypto trading volumes, margin pools, and DeFi yield strategies could suffer. So your job is to watch the flows. Here's one key metric: stablecoin supply moving into exchanges, stablecoin redemption rates, stablecoin issuance growth. When you see stablecoin issuance accelerate under a regulated framework, that's a signal of more capital entering crypto markets. Another metric is capital shifting from banks into tokenized dollars instead of deposit accounts. If institutions prefer minting regulated stablecoins rather than depositing in banks, you'll see a swap of deposits for digital assets, and that creates momentum. The Genius Act pushes precisely in that direction, making stablecoins a regulated option akin to bank deposits but inside crypto rails. Let's zoom into scenario analysis. Scenario A. The Genius Act triggers an explosion in stablecoin issuance. Regulated stablecoins become the standard for institutions. Bitcoin price breaks out to 150,000 plus in the next 12 months. Altcoins rally 3 times to 5 times as liquidity floods into DeFi, lending protocols, Layer 1 ecosystems. This happens if stablecoin flows ramp, regulation stays supportive, global adoption accelerates. Scenario B. The Genius Act causes short-term shock because issuers struggle to meet new reserve audit requirements. Issuance halts, stablecoin supply tightens, liquidity contracts. Crypto prices stall or even correct 20 to 30% as flows reverse and margin crunch hits. This happens if regulation clamps all issuance or banks slow down. So what do? You hedge, you scale, you watch global regulatory headlines, you watch flow metrics. If you are a trader or investor, here are actionable strategies. First, allocate your core to regulated stablecoins as a liquidity base. With regulation clarifying stablecoins, holding regulated stablecoins becomes less risky than unregulated alternatives. Second, watch issuance growth and stablecoin to exchange flows. When large regulated stablecoins begin to flood exchanges, that often precedes big moves in Bitcoin and altcoins. Third, rotate into altcoins when stablecoin flows into exchanges ramp and Bitcoin dominance begins to drop, since that's early altcoin season. Fourth, always have stop loss and risk control, because regulation can also disrupt flows quickly if rulemaking goes wrong or global regulators push back. Now let's explore global implications. The US Genius Act is only one part of the story. Europe, Asia, Middle East, they're watching. The global stablecoin market is expected to grow into trillions of dollars. Some asset managers warn that a sudden surge in stablecoins could destabilize global payment systems if not managed carefully. That means global money may shift into digital dollars, cross-border payments may accelerate, and crypto rails may dominate financial flows. This is not just about crypto trading, it's about monetary architecture. Here's a crucial nuance. The regulated stablecoin rush also means old stablecoins that don't comply may fade or face regulatory pressure. Issuers may need to upgrade their backing, audits, transparency. Some unregulated algorithmic stablecoins might be excluded or disadvantaged. The Genius Act, in fact, doesn't include algorithmic stablecoins under its approved regime, leaving a potential risk for those projects. That creates an interesting investment window. Tokens or platforms tied to compliant stablecoins may benefit, while those tied to unregulated stablecoins may face headwinds. Another dimension, stablecoins as infrastructure for DeFi and lending. With regulated stablecoins, DeFi platforms will gain more institutional credibility. Lending, borrowing, margin derivatives built on stablecoins will attract institutional capital. You might see banks integrate stablecoin rails, tokenized treasuries, and instant settlements replacing legacy systems that can lead to explosive growth in DeFi protocols and Layer 1 chains designed for stablecoin-friendly infrastructure. This is where altcoins that build around regulated stablecoin ecosystems can gain massive upside. But don't ignore the risk side. Regulation can behave like a switch. Flow moves fast. If rulemaking hits delays, if reserve audits find problems, or if redemption stress appears, you could see a stablecoin run, which might drain liquidity from exchanges and force margin calls, triggering a crypto correction. That's why you must monitor regulatory timelines. When the Treasury issues proposed rules under the Genius Act, when public comments open, when enforcement begins. We already have rulemaking underway. Let's refine your mindset now. The crypto mindset for a regulated stablecoin era is different. You need to think infrastructure first, speculation second. Stability of stablecoins plus liquidity of rails plus institutional flows equals the new foundation. That changes how you pick projects. Projects with strong stablecoin partnership, token economics tied to regulated rails, and global compliance will outperform. Projects built purely on hype or unregulated stable systems will face higher risk. Let's talk metrics you should track daily. Regulated stablecoin issuance, US plus global, stablecoin supply growth, stablecoin inflows to exchanges, number of PPSIS and state-qualified stablecoin issuers, global stablecoin regulatory announcements, stablecoin redemption rates, stablecoin-backed DeFi TVL, bank deposit versus stablecoin issuance swaps, interchain stablecoin flows. If you see any of those metrics ramping, you might be at the early stage of a massive crypto move. Now, I want you to project outcomes. If regulated stablecoins become dominant, we may see Bitcoin surge beyond historical norms because liquidity is unlimited relative to past cycles. Altcoins, which integrate or depend on stablecoin rails, may see explosive multifold returns. DeFi may become mainstream finance. That narrative alone could trigger the next major bull run, but if regulation misfires, issuance halts, or stablecoin adoption is delayed, we risk a prolonged consolidation or even a correction. Your job is to stay alert, stay informed, stay strategic. As we approach the close, remember, this isn't just about speculation, it's about a foundational shift in money, finance, and crypto infrastructure. The Genius Act is one law, but a symbol of regulatory legitimacy for stablecoins, and stablecoins are the plumbing of crypto. When the plumbing is upgraded, when flows accelerate, when rails strengthen, when trust is high, then the floodgate opens for crypto. If you understand that, you'll see why Bitcoin, Ethereum, DeFi, altcoins, and margin markets all could go mania. And you'll also see how the trend could reverse if flows choke. So if you're watching this video right now, you are already ahead of the crowd. Most people only notice trends when it's too late. After the big moves have already happened, you are noticing it before the wave breaks, and that is the real crypto mindset. Awareness, preparation, timing, strategy, intelligence, staying ahead of the market instead of reacting to it. So as we wrap up, remember this. Stablecoin regulation is not coming. It is already here. And the next 12 to 18 months will define the winners and losers of this digital transformation. Your job is to stay informed, stay strategic, and take action with clarity. Combine regulated stablecoin flows with crypto's open rails, and you will be positioned not just to survive the future, but to lead it. Thank you for watching, and I'll see you in the next video.